Chegg is under serious threat from ChatGPT and Gemini, AI models that are providing a lot of valuable information. And the question is Chegg going to innovate fast enough to be relevant in the new era of AI and continue to provide students the educational assistance, tutoring, learning assets that they really need to really advance their education? Chegg has been doing this effectively for the last 10 years. But now, with AI being really useful for gathering information, learning topics, learning subjects, getting the information you need to complete a course or learn a topic, it really has potentially disrupted the whole model that Chegg had. So the question is this small company going to make it? Are they going to be relevant? Or will they go by the wayside as a new era in learning and information gathering starts? I'd like to take a look at Chegg as a company, revisit my interest in the company as an investor, and see if I want to continue to invest in this company or if it's time to leave this investment and wait to see what's going to happen now that we're in this AI era. My name is Victor, and in this video, I'm going to share my experience as an individual investor. I don't recommend that you buy Chegg stock. I don't recommend that you sell it. And this is not financial advice. Please make your decisions on which stocks, which investments you get into very seriously. Now, let's take a look at Chegg fundamentals and see what the company's all about. So, as I described, the company overall, they provide a subscription to students that want to learn a particular topic or really just need education assistance. It's a variety of topics you can learn, variety of subjects you can get supported on. I have two sons. One is doing a PhD now, so he's done with his undergraduate degree, and the other is right in the middle of his bachelor's degree. So I was able to ask them if they used Chegg and what their opinions were to put that into my overall assessment of this company. And overall, Chegg is recognized as a really good platform for students. The drawback is that you have to pay to be on the Chegg platform. You have to pay a subscription similar to that of Netflix. Now that you have ChatGPT for free, or you have Gemini from Google for free, is that going to completely eliminate a category of customers for Chegg? I think that's possible, most definitely. I haven't studied it close enough to know that, let's say you're trying to get through a chemistry course. Is it going to give you all the support you need to get through chemistry, college level chemistry, or even high school level chemistry? I don't know. And I'd love to hear comments from viewers to see if you're a student, what your opinion is on that topic. From a fundamental perspective, Chegg has been declining over the years. They had a high point on their stock back in 2021. Their stock was trading above $100 a share. Now their stock's trading at $4.35 a share. During the COVID era, I can imagine a lot of students needed a lot of tutoring because they didn't have in-person contact with their teachers or professors. And Chegg really stepped up. So it made sense that, hey, it was recognized as being a really valuable company in that era. But now that we're past COVID, I think they've had a huge drop in revenues, and the markets recognize that, as well as the threat from AI. So that combination has taken their stock price way down. Their market cap is $447 million, really small market cap, considering that their revenue is $703 million. So you're paying less than 1 times revenue for the company. And the reason for that is you're having a decline in sales. A decline in sales tells investors that, hey, this business may be on its way out. If Chegg cannot stabilize and then start to grow, that conclusion is pretty much set. I think investors will continue to think that way. Forward PE is really low at 3.89. That's as low as you can get. Now, analysts, this is interesting. Analysts say you ought to sell the Chegg stock, but it's discounted by 68%. That's an oxymoron if I've ever heard one. Sell an investment that is heavily discounted. But I guess analysts, when you combine all their opinions, this is the result you get. So most definitely, Chegg was a company that was really valued high and now is really discounted. As we look at their revenue in their income statement, you can see the loss in revenue. And I'm a little surprised that it hasn't been more significant. Year over year, they lost 6.6% of their revenue in 2023. And in 2022, they lost some revenue, 1.21%. As we look at the quarterly, which I'm tracking, they also are losing. If you compare the same quarter to the year prior, they're losing 7% in the most recent quarter, 8% in the last quarter of 2023. I looked at their forecast that they are putting in their guidance for their Q1 earnings, and it's going to be another drop. It's actually going to be a higher drop than 7% for the second quarter of 2024. So that is concerning. The balance sheet's really strong. One thing Chegg has done is they have good cash balance and their debt isn't very high. That is a very good thing. If a company has their debt under control, and they produce free cash flow, the company is going to be around for a long time. On the cash flow front, the good news is that Chegg does produce positive free cash flow on an annual basis. In 2023, they produced $172 million of free cash flow. That's very good. So they keep accumulating cash on their balance sheet. They do have a declining business. But I would say this, that the Chegg business, there's a lot of smart people that put together a technology-based company as a subscription model. And if they have a lot of really smart people that really get education, their innovation is going to make or break Chegg. If they can get the company to grow, this company is going to be relevant. This company could be something. If they cannot grow, they may be acquired by somebody else who just wants to take their intellectual property and maybe combine it. That might be the best, exit strategy, is being acquired by somebody who's more relevant, maybe an Alphabet or a Microsoft that can just buy this little company and put them into their product portfolio and provide it as a subscription to users. Now, looking at their forecast for earnings per share, again, 8 analysts evaluate Chegg and they think it's discounted by 68%, but they do believe that you ought to sell this stock, which is interesting. But their earnings per share is going to be $1.16 in 2024. That's a good earnings per share, and they expect that it's going to grow in 2025. So, hey, that's a pretty good earnings per share. They produce free cash flow that I'm going to use for their valuation. So overall, there is something here of value with Chegg. So what is Chegg worth? Well, I'd like to value the company using their free cash flows and valuing those free cash flows I expect they're going to produce. I'm also going to look at their earnings per share and determine what I think the stock is worth using earnings per share. Then combine those two methods to see what I think the company from a stock price perspective should be priced at. So first, let's take a look at free cash flows. To be really conservative, I'm going to take the trailing 12 months of their cash flow and just take half of that as a starting point. That's really conservative. And I'm just going to grow those cash flows in the first 4 years by 5%. And then after year 4, I'm going to grow those cash flows by 4%. To be really conservative, I'm using a discount rate of 15 to discount those free cash flows to get to net present value. Why 15? Well, this is a company with declining sales that's under threat. And if I'm going to have an investment in this category, I want to be paid a very good return. And that's why I'm going with 15%. So that gets me an intrinsic value, a net present value of all those cash flows of $696 million. They have a really nice balance of cash on their balance sheet of $391 million. I'm going to add that, and I'm going to take away the debt they have on their balance sheet, which is $600. And I'm going to get to an equity value of $487 million. The market cap right now is $448 million. So if we look at the comparison between their equity value and their market cap, it's about a 9% discount that's available on Chegg. Earnings per share. So earnings per share is expected to be $1.16. I'm going to use a PE of 12. This is a tech company. I'm going to use 12. And I'm going to expect that they're going to grow those earnings per share by 3%. Gets a really high, share price using earnings per share of $14.34. And their current stock price is $4.38. So it's a really big discount if you look at earnings per share. When I combine the two, it really offers a high discount. And again, on the free cash flows, I used a really high discount rate. So overall, there's a big discount out there. And really the question remains, is Chegg going to make it? Are they going to be relevant? Or are they going to be acquired? I could totally see another bigger company acquiring this business because they do have positive cash flow. It's a really recognized brand for students. So that might be an exit strategy for this particular company. So should I buy, hold, or sell Chegg? To make that decision, I'm going to look at 3 areas. First, the company, then the balance sheet, then the discount. Let's start with the company. Do I believe in the company, in the business, in their future, in the management team? And right now, I have to admit, I'm unsure. I think the threat of AI disrupting this business is real. And right now, it's a question mark. Will this business model work? Will the subscription model be what works for AI? I don't know. It may. Chegg may end up being really big. Chegg may end up being really small. It's really hard to tell right now because the AI era is so new and I'm not sure what it's going to look like in 2 years, let alone 5. So right now, do I want to be an investor in this company? It's a question mark. Balance sheet. Balance sheet's really strong. Good job, Chegg, for having a lot of cash on your balance sheet. This company could continue to operate for 5-10 years without a problem. If they keep generating free cash flows and the balance sheet they have, they shouldn't have a problem. Discount. The discount on this company is really, really good. So the question is, if they make it, investors will have a windfall. If they don't make it, investors will lose. So this one is kind of a binary decision. Which one do you think? Do you think Chegg's going to make it, or do you think they're not going to make it? That's the question. Overall, I'm going to hold. I have a small investment in Chegg. I've already lost a good percentage of my investment, and it's worth just keeping to see if in a couple quarters they begin to grow. If they show some innovations that really are exciting, then that'll be great. Maybe I might even put in some more capital into Chegg. If not, at this point, it's a small investment, and I didn't lose much to be invested in Chegg as opposed to just selling and moving on. Thank you for watching the video on Chegg. I hope you found it interesting. I'd love to get your thoughts on what you think of this company. What do you think of their future? Thanks again for watching. Good luck investing.